We've taken a much faster route. We would just take the money, buy Bitcoin, and just issue the credit, and we skip all the intermediate steps. That makes us extremely technically efficient. It makes us extremely economically efficient. It makes us extremely tax efficient. This is an extraordinary sea change. We cannot underestimate the value. I think that the fundamentals of the industry are driven by the banks creating credit. One bank can create as much credit as all the Bitcoin miners can create in Bitcoin in a year. So each bank that turns on Bitcoin-backed credit lines might be the equivalent of another halving for the network.
Saylor begins by grounding the discussion in a simple but often misunderstood point. Bitcoin's volatility is well understood and statistically consistent. Bitcoin has historically been a roughly 45 volatility asset. A 45% drawdown from an all-time high, therefore, should not surprise anyone operating with a proper risk framework. Earlier in Bitcoin's history, when volatility was closer to 80% drawdowns were equally unsurprising. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
Our company exists we structure and we secure Bitcoin, right? We're a digital credit issuer. If you look at this chart, what you can see is that the native volatility or the natural volatility of Bitcoin is about 45. For a 45 vol asset to draw down 45% shouldn't shock anybody, right? And I note that Bitcoin looks like it's drawn down about 45% since its all-time high 4 months ago. So a 45% drawdown on a 45 vol asset is probably to be expected, just like an 80% drawdown when it was an 80 vol asset. On the other hand, what you can see pretty clearly is that strategy has stripped that volatility off of BTC with Strike, which was 32%, Stride 27%, Strife 24%, and Stretch down to 7%. So we are stripping the volatility off of Bitcoin, and there is conservation of energy and conservation of volatility. And so the volatility that we strip off of the credit instruments accrues to the common equity. And so that's why MSTR 63 vol. But it's not really a complicated piece of engineering. It is very pure financial engineering. There's a group of people that want low vol, principal protected instruments that are credit instruments, and there are other people that want high vol, high performance. Right? Think of us as a digital credit vehicle. Our job, we are thrusting forward. We are actually moving through space through issuing digital credit, right? It's digital credit is the product, Bitcoin is the backing collateral. The secret or the most important thing for us to do is to build the vehicle in the most robust, fault-tolerant way that we can, the most scalable way we can. You could think of it as a Bitcoin battery and then a US dollar battery. And we have lots of options. We have options to run on the US dollar reserve. We have the option to sell equity. We have the option to sell Bitcoin. We have the option to sell Bitcoin derivatives. And we keep our options open so that we can do the best thing for all of our stakeholders. Our common stock shareholders, we want to do the right thing for the MSTR common stock shareholders. We want to do the right thing for the credit holders of the digital credit instruments. And we want to do the right thing for the Bitcoin community. And we believe that if we're rational and thoughtful, then we get a good outcome, which is BTC positive, MSTR positive, STRC positive. Companies exist to convert capital into cash flows. In essence, you have capital investors and you have credit investors. The credit investor wants $10,000 a month forever. And the capital investor gets $1 million of real estate with no cash flows for the next 30 years. And maybe they'll get more than 10% a year. Maybe they'll get 20, 30% a year performance. But it's pretty straightforward that the world's built on capital. The world runs on credit. BTC is digital capital. STRC is digital credit. It takes an operating company to transform capital into credit. If we were a real estate development company, we could take $50 billion of capital, buy a bunch of land in New York City, build a bunch of buildings, market the buildings, rent the buildings, and generate the cash flows. That's a way to do this, but you take on all sorts of liability, all sorts of counterparty risk, operating risk. It takes a lot of time. You have property taxes, employment taxes, income taxes, usage taxes, etc. That's the 20th century way to actually create credit from capital. We've taken a much faster route. We would just take the money, buy Bitcoin, and just issue the credit, and we skip all the intermediate steps. That makes us extremely technically efficient. It makes us extremely economically efficient. It makes us extremely tax efficient. At the core, what are we doing, right? We're transforming that capital into credit. We're taking BTC and we're converting it into a currency, whether it's a US dollar or a euro. We're stripping the risk by over collateralizing it, right? If you have $5 of Bitcoin, right, and it falls by 80%, then you've got $1 of Bitcoin. But when you have $1 of STRC backed by $5 of Bitcoin and it falls by 80%, you've still got $1 of STRC backed by $1 of Bitcoin. So we're stripping or reducing the risk by the BTC rating. And then we're also taking other actions to reduce risk, right? We're an operating company. We can raise capital. We can sell equity. We can refinance. We can strip risk by taking a 2-year obligation or a 10-year obligation and stretching it out to a 20-year obligation. So operating companies can do these things. We're also damping the volatility. We damp the volatility by building the collateral, by building the US dollar value, by adjusting the dividends, by adjusting the ATM programs, by adjusting our capital markets behavior. And we adjust these things minutely every minute, maybe even every second, right? We have programs to adjust all of our activities so as to damp volatility, and we're very engaged and we're very focused on it. Of course, and then we distill the yield from the capital asset in order to create a fixed income yield rate. And of course, we're compressing the duration. Instead of telling you to wait 10 years in order to get a 30% return, we're giving the 18-year-old cash flow this month and every month. So 10 years of duration is 120 months. We're converting 120 months into 1 month duration. And so when people say, what does the company do? The company transforms digital capital into digital credit. Are these things valuable? Of course they're valuable. There's a $300 trillion market for credit. It's extraordinarily valuable. And the key is for us to create the best credit in the world and to create the best credit you can using digital capital.
Perhaps the most powerful concept Saylor introduces is duration compression. Bitcoin, as a capital asset, may deliver extraordinary returns, but only over long horizons. A holder might wait 10 years for those returns to materialize. Through digital credit, the company compresses that 10-year duration into monthly cash flows. Instead of waiting a decade, investors receive income immediately. In effect, future performance is monetized in the present. This is the transformation of digital capital into digital credit.
How do we benchmark ourselves against the other credit alternatives? Well, the bank accounts might give you 40 basis points. The money markets are giving you 360 basis points. Taxable. Insurance companies don't pay tax and endowments don't pay tax, but actual real people, families do, private companies do, public companies pay tax. The world's full of people that have to pay tax. And so 360 basis points of money markets, works out to might be only 180 basis points if you live in New York or California after tax. So clearly what we have here is a yield-starved environment. The base rate and the risk-free rate is 360 basis points taxable. And that means that all the conventional credit instruments are pegged to that, like mortgage-backed securities, investment-grade bonds, junk bonds. They all trade at very small premiums or spreads over that risk-free rate. And STRC is paying 11.3% at par, 11.25% at par. And so you can see here that it's 3 times more on a pre-tax basis, but on a tax equivalent basis, it's like a bank account in Miami that pays you 18%. It would be much more. It'd be like a bank account that pays you 22 or 23% in New York City or San Francisco. So we think we've been able to create a very compelling credit instrument versus other credit instruments. It's just 2 to 4 times better. We're looking out 7 years, and so one model is we target 5% BTC yield and we increase Bitcoin per share by 1.4 over the 7 years. The mid case is we target 10% BTC yield. Yeah, 10% BTC yield. In that case, we'll double Bitcoin per share over 7 years. And the high end would be a higher yield than 2.5x Bitcoin per share. What is our objective? Our objective is to double your Bitcoin per share, right? Over 7 years, right? I mean, I would be disappointed if we don't double Bitcoin per share over a 7-year time frame. This chart actually shows how the amplification works in practice. By selling digital credit, we create an amplification. So if Bitcoin ARR was 10%, we could achieve a 12 to 19% ARR. If Bitcoin was a 30% ARR, we could achieve a 36 to 45% if we execute on our strategy. So clearly, the equity is for vol junkies and performance junkies. They want to outperform. This is how we believe you can best outperform Bitcoin in the most responsible fashion while doing the most good for the world. And for the other end of the spectrum, for the credit investors that can't stand the vol, they want principal protection and low vol and no currency risk, and they want clear yield, and they want tax efficient treatment. Well, then they have digital credit and Stretch specifically. Capitol Hill has embraced Bitcoin. We've got bipartisan consensus that the United States should embrace digital assets, should embrace digital capital, should be a leader. That is not a debate. No one's saying that there's one party in favor of digital capital, another party against it. That's a big deal. So although the political process is complicated, the fact that we have moved from an asset which was a scary speculative thing and maybe illegitimate to a legitimate asset that most reasoned politicians and regulators and policymakers believe they need to move constructively forward with. Big banks are embracing Bitcoin. Roll the clock back 18 months, and this Harvey ball diagram is pretty much blank, mostly blank. And so when you actually look at the top financial institutions and you ask the question, do they allow IBIT trading? Well, there's an avalanche of support there. That's flipped in 12 months. The second question is, do they offer credit against IBIT? That's a big deal. 12 months ago it was almost impossible to get a loan or a margin loan against IBIT. Now there are many banks coming into space. Would they let you trade BTC? Now you have banks that are announcing support for that. You have banks announcing support to custody BTC. And you have banks announcing intent to offer credit against BTC. Again, this is an extraordinary sea change. We cannot underestimate the value. I think that the fundamentals of the industry are driven by the banks creating credit. One bank can create as much credit as all the Bitcoin miners can create in Bitcoin in a year. So each bank that turns on Bitcoin-backed credit lines might be the equivalent of another halving for the network. TradFi and FinTech have embraced Bitcoin. If you look at the number of accounts with BTC trading asset, there's a pretty clear bullish trend here, both across crypto native exchanges, FinTechs and neobanks, and the brokerages and banks and the wealth management channel. Those are large numbers. Fundamentally, we're going from an asset class that no one could buy if they wanted to an asset class where everyone is competing to facilitate access and exposure. This is the ETF trend. ETFs are embracing Bitcoin. 125 ETFs or ETPs launched. 1.4 million Bitcoin held in them. A very consistent trend up and to the right. And this is the corporate trend. It was nothing in 2019. We were the first serious player. We were lonely for a bit, then we went to 33, then we were 64 in 2024, and now we're 194. This is clearly explosive growth, and there's a signal here.
Michael Saylor's thesis is ultimately about maturation. Bitcoin is evolving from a volatile, niche asset into the backbone of a new credit system. Through disciplined engineering, over-collateralization, and institutional integration, digital capital is being industrialized. This transition will not eliminate volatility, but it will harness it. It will not simplify finance, but it will make it more efficient. For those who understand the architecture being built, this moment represents not the end of Bitcoin's story, but the beginning of its role as a foundational layer of global credit.